Multinational operations. This reading is about different kinds of multinational operations. We'll start out by talking about foreign currency transactions. So this means that, let's say, company A is based in a certain country and this engages in transactions in different currencies. So company A might be in the US, it engages in transactions with, let's say, a UK based company. Now, these transactions will be in British pounds. So how do we account for these transactions? That's what we will talk about here. Then from transactions, we will move on to translation. Translation of foreign currency financial statements. Here we have a company in a given country, but then this country has actual operations in a different country. In this case, again, let's say that company A is in the US and it has operations in the UK. So this UK subsidiary will work in pounds. The question now is, how do we take the financial statements from here and then move them into a consolidated financial statement for company A? That consolidated financial statement will be in dollars. So how is this translation done? That's what we will talk about here. Then we move one step further and talk about translation when a foreign subsidiary operates in a hyperinflationary economy. So in this case, company A has a subsidiary in a country where there is hyperinflation. We'll talk about what exactly is meant by hyperinflation and then the different ways in which we account for this subsidiary. Then we'll talk briefly about multinational operations and a company's effective tax rate. And the final segment will be related to additional disclosures on the effects of foreign currency. The two major aspects that we address in this reading are foreign currency transactions and the translation of foreign currency financial statements. Section 2 deals with foreign currency transactions. Let's first look at a few basic definitions. Presentation currency. This is the currency in which financial statement amounts are presented. It is generally the company's residence or where the company is domiciled. The functional currency. This is the currency of the primary economic environment in which an entity operates. We will talk about the functional currency in more detail later. In the context of foreign currency transactions, generally these two currencies will be the same. You will hear the term foreign currency and the term foreign currency transaction. A foreign currency transaction is a transaction in any currency other than the functional currency of a company. There are two broad types of financial currency transactions, either import-export transactions or lending-borrowing transactions. These can result in foreign currency assets and liabilities. As a simple example, let's say that you have a United States-based company which imports from Mexico. So goods are imported, but the payment is made in Mexican peso at a later point in time. This means that an accounts payable is created, payable in the foreign currency, and that will result in some foreign currency risk. An export transaction will also result in some foreign currency risk if there is a difference between when the sale happens and when the money will be received. And again, the foreign currency risk is there if the money is being received in the foreign currency. We'll now talk about these transactions in a little more detail. Let's look at an import transaction first. We have foreign exchange risk or foreign exchange exposure if the importer is required to pay in the foreign currency and the settlement date falls after the purchase date. The risk to the importer is that the functional currency may weaken against the foreign currency. So going back to my example, If we have a United States based company, then we are assuming that the presentation currency and the functional currency is the dollar. This particular company imports goods from Mexico and needs to make a payment in Mexican peso at a later point in time. The risk here is that the Mexican peso appreciates, which is the same as saying that the US dollar, the functional currency in this case, weakens. With an export sale, there is foreign exchange risk if these two conditions hold. The exporter agrees to be paid in the foreign currency and settlement date falls sometime after the sale date. Again, let's go back to the US company with dollar as the functional currency. Let's say that this company exports goods to the UK, which means that the payment will be made in pounds. If this payment is being made at a later point in time and the pound weakens, which is the same thing as saying the dollar strengthens. So if that happens, then this will have a negative impact on the exporting company. That is the foreign exchange risk. Both US GAAP and IFRS require the change in the value of foreign currency assets or liabilities resulting from foreign currency transactions to be treated as a gain or loss reported on the income statement. So whether this gain or loss is realized or unrealized, it needs to be shown on the income statement. Let's look at example 1 from the curriculum, which deals with settlement before the balance sheet date. I want you to read this and try it on your own before looking at the solution. Here is roughly what you should come up with, and I'll just highlight a few points. Notice that our company, Finco, is based in Europe and the functional currency is the euro. The foreign currency in this context is the Mexican peso. And this is an import related transaction. So goods are being imported and a payment needs to be made in Mexican peso at a later point in time. The next point to note is that in the way the currency exchange rates are given, the Mexican peso or the foreign currency is the base currency because we have one unit of the base currency. And also the Mexican peso is appreciating, which means that the euro is weakening. This obviously is a negative for the importing company because it is now having to pay in peso, which is more expensive. This is a higher number. And that is shown over here through the fact that there is a foreign exchange loss because of the appreciation of the foreign currency, and that carries over to retained earnings. This is a realized loss. The balance sheet date is 31st December. The loss is realized on 15th December when the payment is made. So we see the loss in the income statement over here, and we also see the impact in shareholder equity. Example 2 deals with a situation where settlement happens after the balance sheet date, and I want you to try this first before looking at the solution. Here is what you should get. Now note that this is an export transaction. So goods are being exported and money is being received later. The functional currency is the euro. The foreign currency now is the pound. And notice that between 15th December and 31st December, the pound appreciated. And this is good news now because we are dealing with an export transaction. So pounds are coming in. Since pounds are coming in, we are happy if the pound goes up in value. If you look at 15th November and then 31st December, because of the appreciation of the pound, there is a foreign currency gain. That gain is equal to 200. But then between 31st December and 14th January, the value of the pound goes down. And that is reflected here as a negative number. The 200 is shown as an unrealized gain on the income statement. But on 15th December, the overall gain of 150 is realized. Between 31st December and 15th Jan, there is a loss of 50. Note that just because we have an unrealized gain of plus 200 over here, this is not necessarily indicative of the final realized gain for the company. This slide summarizes what we are talking about and is important from a testability perspective. Whether a change in exchange rate results in a foreign currency gain or loss depends on two things. The nature of the exposure to foreign exchange risk, whether it's an asset such as a receivable or a liability such as a payable, and the direction of change in value of the foreign currency. Is the foreign currency strengthening or weakening? For an export sale, an asset is created. The foreign currency strengthening will be a good thing. The foreign currency weakening will result in a loss. With an import purchase, the situation is the other way around. And again, make sure you know this table very well. A few basic analytical issues. Both IFRS and US GAAP require foreign currency gains and losses to be reported in net income even if they have not yet been realized. But neither standard indicates where on the income statement these should be placed. These are the two common treatments. Number one, as a component of other operating income or expense, and number two, as a component of non-operating income/expense. In some cases, this is shown as part of financing cost. With this point, notice that given the subjectivity, there is work for an analyst to do when comparing two different companies. If one company is reporting the transaction gains and losses in the operating part of the income statement and another is reporting numbers in the non-operating part, then clearly adjustments have to be made before a comparison. Example 3 in the curriculum illustrates how the calculation of profit margins, especially operating profit margins, are impacted by foreign currency gains and losses. This is a very simple example, so I'm not covering it here, but I would like you to read this from the curriculum. Also, as we saw in example 2, unrealized foreign currency gains and losses on the balance sheet date are not reflective of the ultimate realized foreign exchange gains and losses. Disclosures related to foreign currency transaction gains and losses. Both IFRS and US GAAP require that foreign currency gains and losses for a given period be shown on the income statement. They have slightly different ways of stating this, but effectively both statements here mean the same thing. A company might disclose that the transaction gains and losses are immaterial for a given period. This might happen if the gains and losses cancel each other out. There might also be a situation where in a given period, the foreign currency transactions are extremely few. Some companies might use hedging instruments to minimize foreign exchange risk. If this does happen, then the company needs to disclose what hedging instruments are being used. Before we go into the details, let's go over some basic conceptual issues related to translation. And we'll understand this through an example given in the curriculum. We have a Spanish company called Spanco, and when I say we, I will often refer to us as this company. our context will be that we are the parent company and we have subsidiaries in other countries. So for example, in this case, we are Spanco. This is the parent company based in Spain. So the presentation currency, or the currency in which we report our numbers, is the euro. We have a subsidiary in America, and the name of that company is Americo. Obviously, Americo will buy and sell over here in America. The US dollar is the foreign currency. On balance sheet dates, the assets and liabilities of this subsidiary need to be translated to euro, and these translated assets, liabilities need to be shown as part of the consolidated financial statements of Spanco. When we do this translation, and note that we are now using the term translation as opposed to the earlier section where we were talking about transactions. So when we translate financial statement elements, there are two core questions or conceptual questions that need to be addressed. The first is, what is the appropriate exchange rate to be used in translating each financial statement item? For example, should we use the exchange rates that were in effect when the asset was purchased? Do we use the average exchange rate, the exchange rate at the end of the period, in other words, the balance sheet date? So there are several exchange rates that could be used, and we need to figure out which one to use. The second question is, how should the translation adjustment that inherently arises from the translation process be reflected in the consolidated financial statements? In other words, how is the balance sheet brought back into balance? So let's dive into these conceptual issues by looking at some numbers. Again, we continue with Spanco. Americo is the American subsidiary which is established on this date, the end of, let's say, 2001. And here is the investment. The investment is 10,000 euro. Conveniently, our exchange rate when this subsidiary is established is $1 is equal to 1 euro. This is what the American subsidiary then does. So when the American subsidiary starts, the balance sheet in US dollar terms looks like this. It is a very simple balance sheet. And the translation process is also straightforward because we have 1 euro to $1. So in the translated euro terms, the balance sheet looks exactly the same. But then the dollar weakens relative to the euro. On 31st March, so that's 3 months later, 0.8 euro is equal to $1. Note that we are taking the foreign currency, which is the dollar, as the base currency, 1 unit of the dollar. Now, given this new rate, how will we translate the balance sheet of the subsidiary? Broadly speaking, there are two translation methods. One method is that all assets and liabilities are translated at the current exchange rate. When we say current in this context, we mean the current rate on 31st March 02, which is 0.8 euro to the dollar. The other method is that only monetary assets and liabilities are translated at the current rate, and non-monetary assets and liabilities are translated at historical exchange rates. Historical exchange rates would be the rates that are in effect when, let's say, the assets were purchased. This is what the balance sheets would look like, or the translated balance sheets would look like under the two different methods. Method one was that all assets and liabilities are translated at the current rate. So notice that this 0.8 is the current rate. The C stands for current. So all assets and liabilities are translated at the current rate. Common stock is translated at the historical rate. Just remember that this happens no matter what method we use, and we'll discuss this in more detail later. Method 2 says that only monetary assets and liabilities are translated at the current rate. So cash obviously is monetary, so that's translated at the current rate. Inventory is non-monetary, so this is translated at the historical rate per method 2. And then liability is monetary, so that's translated at the current rate. Common stock again is translated at the historical rate regardless of the method. Method 1 is called the current rate method. So all assets and liabilities translated at the current rate. Method 2 is called the monetary non-monetary method or the temporal method. And the term used in the curriculum, in the learning objectives, and then later in the practice problems is temporal method. So effectively, the two translation methods are the current rate method and the temporal method. The reasoning behind the temporal method is that all assets and liabilities measured at current value on the balance sheet should also be translated at the current exchange rate. If an item is carried at historical cost, then it should be translated at historical rates. So that makes sense. On the other hand, if an item is carried at current market value or current fair value, then it should be translated at current rates. Section 3.2, Translation Methods. This, I'd say, is one of the most important slides in this presentation, and if you do get a question related to translation, it is very likely that you will be tested on the concept that we discuss here. And the concept is this: how do we decide which method to use? How do we decide between the current rate method and the temporal method? And the answer is shown right here. If the foreign subsidiary's functional currency is different from the parent's presentation currency, then we use the current rate method. On the other hand, if the foreign currency's functional currency is the same as the parent's presentation currency, then we use the temporal method. Now, clearly we need to understand what exactly is the functional currency and how do we decide on the functional currency of the subsidiary. And these are the factors that you consider. What is the currency that influences sales prices? And remember, we are talking about the subsidiary here. So if we are the parent company, we are Spanco and our presentation currency is the euro. Our subsidiary is in America. The foreign currency or the local currency in America is obviously the dollar, but what is the functional currency? This might not obviously be the dollar. If there is a business, if a subsidiary in America buys in dollars, sells in dollars, the entire economic environment is dollar based, the pricing is based on the competitive environment in the United States, then it makes sense for the functional currency to be the dollar. So if you look at all these bullet points, this will help you decide whether the dollar is the functional currency or not. You might have another situation where effectively Spanco is exporting product to the United States and the product is being sold at a price which is determined based on the dynamics in the euro market. And let's say that the salaries are also based on European salaries. Then we could say that even though goods are being sold in America through this subsidiary, but the functional currency is the euro. The case that I just talked about, where even though the subsidiary is in America, but the functional currency is the euro, then we have this scenario and we need to then use the temporal method to translate the financial statement items from the subsidiary to the consolidated balance sheet of the parent. On the other hand, if we have this situation where the foreign sub's functional currency is different, then we would have to use the current rate method. This is critical, but students often forget. So I'll give you two little techniques to remember. One simple thing to remember is just DC, or let's say direct current. If there is a difference between the foreign subs functional currency and the presentation currency, then use the current rate method. That's one silly way of remembering. The other somewhat intuitive method is the following. If the foreign subsidiary is using a different currency altogether relative to the parent's presentation currency, that is more risky relative to this other scenario where the functional currency is the same. When there is more risk, then we tend to be more careful or more conservative. The more conservative thing to do is translate all assets and liabilities at the current rate. So again, that's what's happening over here. Now we'll talk about the current rate method in more detail, and the next slide will talk about the temporal method in more detail. So we emphasize this point again. If the foreign entity's functional currency is different from the parent's presentation currency, then use the current rate method. What is the procedure here? All assets and liabilities are translated at the current exchange rate at the balance sheet date. So if the balance sheet date is 31st December 2002, then we look at the exchange rate on that day and translate all assets and liabilities based on that rate. Stockholders' equity accounts are translated at historical exchange rates. Just take this as a given. And finally, revenues and expenses are translated at the exchange rate that existed when the transactions took place. This can be a little cumbersome. So for practical reasons, what most companies do is take the average exchange rate over the period and use that average exchange rate to translate all revenue items and expense items. With the current rate method, there is going to be a net translation gain or loss, and this happens because the exchange rate changes. This net translation gain or loss does not flow through the income statement. It needs to be reflected in equity. In other words, there is a component in equity that covers the net translation gain or loss. You might be wondering why the translation gain or loss goes straight to equity and bypasses the income statement. The reason is that you are the parent and you have invested in this foreign subsidiary. The foreign subsidiary is operating in its own currency. Remember here, the functional currency is different from the presentation currency of the parent. So if the foreign currency appreciates and there is a gain, you are only going to realize that gain when you spin off or sell this subsidiary, which is not likely to happen anytime in the near future. Remember the going concern assumption here. So if this is not going to happen in the near future, then it does not make sense to have the translation gain be reflected in the income statement. Very roughly speaking, this is analogous to the way we treated available for sale securities earlier on in the course. Remember, with AFS, even though AFS securities are shown at fair value or market value, but the unrealized gains or losses do not flow through the income statement. Unrealized gains and losses go straight to equity. Same treatment over here. The next point has to do with the balance sheet exposure. When we talk about balance sheet exposure, what we are talking about is the fact that assets are being translated, liabilities are being translated. So net, are we going to have assets being translated or liabilities? If the value of assets being translated is greater than the value of liabilities being translated as shown over here, then we have a net asset balance sheet exposure. So effectively we then have a net asset, which means that with a net asset, if the foreign currency appreciates, then that will have a positive impact on the balance sheet. With the current rate method, since we are translating all the assets and all the liabilities, generally there will be a net asset exposure. Next, we come to the temporal method, which is a little more complicated. We use this method when the foreign currency's functional currency is the same as the parent's presentation currency. With assets and liabilities, here is the procedure that we use. Monetary assets and liabilities are translated at the current exchange rate. So remember, monetary at the current exchange rate. Non-monetary assets and liabilities measured at historical cost are translated at historical exchange rates. Non-monetary assets and liabilities measured at current value are translated at the exchange rate at the date when the current value was determined. Stockholders' equity accounts are translated at historical exchange rates. So again, remember the fact that with both methods, the stockholders' equity is translated at historical exchange rates. And then revenue and expenses. Revenue and expenses other than those expenses related to non-monetary assets are translated at the exchange rate that existed when the transactions took place. Expenses related to non-monetary assets such as cost of goods sold, depreciation and amortization are translated at exchange rates used to translate the related items. We will understand these points through examples. First, let's look at a few finer details related to the temporal method. When using the temporal method, companies must keep record of the exchange rates that existed when non-monetary assets such as inventory are acquired, because we need to use that particular exchange rate for inventory which was in effect when the inventory was acquired. Remember, inventory is considered a non-monetary asset. The historical exchange rates used to translate inventory and then cost of goods sold under the temporal method will differ depending on the cost flow assumption. Recall from before that cost flow assumption could be last in, first out, and weighted average. And we are going to look at an example later that deals with these possible scenarios. The translation adjustment needed to keep the translated balance sheet in balance is reported as a gain or loss in net income. So remember, this gain or loss, the translation gain or loss with the temporal method does flow through the income statement, and this is different from the current rate method where the translation adjustment or translation gain loss is shown through equity. Now, why the difference? I've already explained the reasoning behind the current rate method. With the temporal method, we are saying that the functional currency of the subsidiary is the same as the functional currency of the parent, or more precisely, the functional currency of the subsidiary is the same as the presentation currency of the parent. If this is the case, then whatever activity is happening related to a foreign subsidiary, even though sales might be happening in the local currency, but the local currency will be converted relatively quickly into the functional currency, which is the same as the presentation currency. Since this conversion is likely to happen in the near future, it makes sense to show translation gains and losses in the income statement. Very roughly speaking, this would be analogous to held for trading securities. Next, we come to balance sheet exposure. Here again, we look at exposed assets versus exposed liabilities. And I want to make sure you understand what this term exposed means. By exposed, we mean the assets that will be translated at current rates. And exposed liabilities are the liabilities which will be translated at current rates. Assets and maybe some liabilities which are being translated at historical rates are not exposed to variations in the foreign exchange rate. Generally, with the temporal method, we are likely to have a net liability exposure because most probably the monetary assets, which are the only exposed assets, are probably going to be less than the monetary liabilities. And in the example that we will consider over the next few slides, this is the scenario. Here I'm simply reproducing Exhibit 4 from the curriculum, which summarizes what we've been talking about. So I want you to carefully go through this and make sure you understand what is being stated. On the left, we have the current rate method, and on the right, we have the temporal method. Note that with the temporal method, non-monetary assets are being translated at historical rates. Note that with revenue and expenses, both methods use the average rate. However, under expenses, if we have non-monetary assets, then such as inventory, and then when inventory is sold, then the relevant expense is the cost of goods sold, then we use the historical rate. Now I'll have you do this question, and I'm going to discuss it with you because over the years many students have had issues with this combination of FIFO, LIFO and the translation method. So try this first and then I'll explain what you need to do. Here is the solution. Given rising prices, FIFO COGS will be the lowest. And given a depreciating currency, the current rate method will give us the lowest COGS. So that's the answer, FIFO and the current rate method. Now, what is the logic that has been used? Let's break this into two parts. One is the impact of the cost flow assumption, and the second is the impact of the translation method. And I'll go back to my very simple scenario. 1122. We have rising prices, and note that this is a US company with a sub in Turkey. The relevant numbers are the costs in Turkey, the costs related to the subsidiary, and the value of the foreign currency. The inflation rate or the prices in the parent country don't matter in this scenario. When you have rising prices, then which method will give you the lowest COGS? Which inventory flow method? And the answer is FIFO, because with FIFO, we have first in, first out. So the low cost items that came in first are being sold. So FIFO is going to give us the lowest COGS. That is fairly straightforward. What about the current rate method versus the temporal method? Remember, with the current rate method, we are using the average exchange rate, whereas with the temporal method, we are using the exchange rate in effect when the items were bought and sold. So let us say that we have an exchange rate of 1 and we are taking the Turkish lira as the base currency. We don't know the exact exchange rates, and that's not really relevant. What we do know is that the Turkish lira is weakening. So we can say that the exchange rate goes from 1 down to 0.5. That's substantial weakening, but it will help illustrate the point. We can then say that on average, the exchange rate was 0.75 over the year. This is the rate that will be used by the current rate method. What about the temporal method? The temporal method is saying that we use the rate that was in effect when these items were sold. The items were sold early in the year, and when they were sold, the cost that we are using is the cost based on early in the year. So that means that we will also need to use the exchange rate based on early in the year, which is relatively high. Remember, the currency is depreciating. So if we are using these relatively high exchange rates, then COGS, as expressed in the presentation currency, is going to be relatively high with the temporal method. Therefore, we can say that the current rate method is going to give us a lower COGS when expressed in the US dollar or the parent's presentation currency. Make sure you understand this, because when you look at the practice problems at the end of this reading, there will be a few questions that deal with the same concept. And I know that in the past, many students have been confused by this particular scenario. Next, we come to example 4, and this is a little bit tricky because the discussion on inflationary economies actually comes later in the curriculum. But here what has been done is an example has been given, again with a US-based parent company and a subsidiary in Turkey. And we are told that in Turkey we have very high inflation. And then we are asked to translate using the current rate method, and then translate using the temporal method, and then translate using a third method. So given what you've learned so far about the current rate method and the temporal method, I want you to do the translation and see if you come up with the same numbers shown over here. We will make a separate video available that goes through these numbers in detail. Don't worry too much about this method right now. When you go over a later segment dealing with hyperinflationary and highly inflationary environments, then this particular method will make sense. We now come to section 3.3, where we will look at an illustration of translation methods. And this will be through an example presented in the curriculum. This is an embedded example. It's not one of the blue box or gray box examples. Interco is a European company. So our parent company is based in Europe. The presentation currency is the euro. This parent company establishes a subsidiary in Canada. The foreign currency is the Canadian dollar. There is a question as to whether the current rate method should be used or the temporal method should be used. And in this example, we are going to use both methods and look at how using different translation methods can result in substantially different numbers on the income statement and balance sheet. When the subsidiary is established, this is what the balance sheet looks like. And note that here the numbers are presented in Canadian dollars. This is the foreign currency. The first question for you is, what is the balance sheet exposure? If we use the current rate method and translate all the assets from Canadian dollars to euro and translate the liabilities from Canadian dollars to euro, then note that the exposed assets, which is essentially all the assets, exceed the exposed liabilities. So with the current rate method, we would have a net asset exposure. On the other hand, if we use the temporal method, then we would translate cash, which is our only monetary asset, and our liability, which is also monetary. So note that in this scenario, we have a net liability exposure. Then we are given this particular income statement for the year of operation. And the numbers are shown in Canadian dollars. Our job will be to translate the income statement numbers and the balance sheet numbers into the parent's presentation currency. Over the year, this is what happens to exchange rates. First thing I want you to note is that the foreign currency or the Canadian dollar is the base currency. This is appreciating. So on 1st January, the exchange rate is 0.7 and over the year, it goes up to 0.8. So the foreign currency is strengthening. Also note that we have been given the average rate. This is going to be used on the income statement. We are also given the weighted average rate when the inventory was acquired, the rate when dividends are declared, and then the rate at the end of the year. When we translate at the end of the year, this will be considered the current rate on that date. Here is what the income statement looks like using the current rate method. This is our foreign currency. On the left, we are translating using the current rate method. Note that with the income statement, we are translating all items using the average rate, 0.75A. A stands for the average rate. The dividend is translated at the rate which was in effect when the dividends were declared. Also note that as we discussed earlier, the translation gain loss does not flow through the income statement when we use the current rate method. This goes straight to equity. On the right, we have the temporal method where sales are translated at the average rate. Cost of goods sold, we use the historical rate of 0.74, which is given. Selling expenses are at 0.75 average rate. Depreciation is translated at historical rate. Interest expense and income tax expense at the average rate. So we come up with this number. There is a small difference in the income before translation gains and losses, and that small difference can be attributed to using a different rate for the non-monetary expenses, inventory and depreciation. Then these particular items, they need to be arrived at after we study the balance sheet. With the temporal method, the balance sheet needs to be translated first because we need to look at the revised value of the monetary assets and liabilities. By revised, I mean the value based on the current exchange rate. Based on that, we will come up with a value for retained earnings, and then we can work backwards to figure out the number for the translation gain or loss. As you can see, we have a translation loss over here. The amount of the loss will obviously be determined once we look at the balance sheet, but you should be able to figure out without looking at the balance sheet that there will be a loss as opposed to a translation gain. And why do I say that? If you recall, when we use the temporal method, we are only translating monetary assets and monetary liabilities. And based on the balance sheet, we know that the monetary liabilities are greater than the monetary assets. So we have a net liability exposure. We also know that the foreign currency strengthened. So the Canadian dollar went up in value. If the Canadian dollar or the foreign currency goes up and we have a net liability exposure, then that is a negative because this means more of an exposure. Higher exchange rate. More of an exposure means that there is a translation loss, and that's why we have a negative over here. Now we come to the balance sheet. The current rate method is straightforward. All assets translated at the current rate, all liabilities translated at the current rate. The equity is translated at the historical rate. The temporal method is a little more complicated. Monetary assets translated at the current rate, inventory translated at the historical rate which was given, non-monetary assets translated at the historical rate, monetary liabilities translated at the current rate, capital stock or equity translated at the historical rate, and then we need this number to balance. In other words, we do have this number for total assets. We also know the value of our liabilities. So assets minus liabilities will give us equity. Part of the equity is already explained using the historical rate, and the amount that is not explained then is simply a plug. So this must be the value for retained earnings in order for assets to be equal to liabilities plus equity. This plug for retained earnings is then taken to the previous slide where we can then compute the translation loss. This is Exhibit 5 in the curriculum. It actually is shown a little later, but I think this is a good place to discuss the material shown over here. And I'd say that from an exam perspective, understanding this exhibit is essential. We know that our parent's presentation currency is the euro, the foreign currency is the Canadian dollar, and in our example, the foreign currency has strengthened. So that means that this is the scenario we are dealing with. Also, when we use the temporal method, then we have a net liability exposure. So in the temporal method context, this is what we just dealt with in our example. Notice that with the foreign currency going up, that has a positive impact on revenue, a positive impact on assets, a positive impact on liabilities. However, since the liability exposure is more than the asset exposure, the impact on net income is negative and the impact on shareholder equity is negative. And therefore, there is a translation loss. If there was another scenario where there was a net asset exposure, then all the numbers would be positive and there would be a translation gain. With the current rate method, all assets and all liabilities are being translated. So given that all assets or the value of total assets exceeds the value of total liabilities, we have a net asset exposure under the current rate method. So all these numbers are going up. The revenue is higher because the exchange rate went up, assets higher, liabilities higher, net income higher, shareholder equity higher, and the translation adjustment would be positive. This translation adjustment, however, shows up as equity, or it shows up directly in the equity part of the balance sheet. Whereas with the temporal method, the translation loss or gain shows up in the income statement. What if we had another scenario where the foreign currency weakened? Then with the weakening foreign currency, the revenue would be down, assets down, liabilities down, but these two numbers are up, and that is because in this column we are assuming a net liability exposure. So hopefully this does not surprise you. The scenario here is exactly the opposite of the scenario in the top left segment. Again, I'll emphasize that you need to know this exhibit very well. If you have time, then go over example 5 and example 6. Example 5 deals with the impact of different balance sheet exposures under the temporal method, and example 6 deals with the effect of direction of change in exchange rate on the translated amounts. Section 3.4 deals with translation analytical issues. We continue with the same example and demonstrate the fact that depending on the translation method used, the net income can be quite different. The asset and liability values are also different depending on the translation method. The net income with the current rate method is 885,000. With the temporal method, it is much lower because we show the translation loss as part of the income statement when we use the temporal method. That explains why this number is substantially lower than the net income arrived at using the current rate method. However, if the translation impact is removed and we look at income before the translation gain or loss, then the temporal method actually gives a higher income. Now, what does this mean for you as an analyst? Clearly, if two companies are similar and use a different method to translate, then you have to make adjustments. From an exam perspective, you are quite likely to get a question that compares the impact of using the current rate method versus the temporal method. You are also likely to understand the impact on ratios. In our example, the foreign currency strengthened. So what is the impact on the current ratio? The current ratio is current assets over liabilities. The first column simply gives numbers in Canadian dollars, and then these two columns, the second column gives the ratios assuming the current rate method, and this column gives the ratios assuming the temporal method. Why is this ratio, the current ratio using the current rate method, greater than the current ratio using the temporal method? Current ratio is current assets over liabilities. With the current rate method, all the current assets are being translated using the higher rate. Whereas in the temporal method, only the monetary assets are being translated. Inventory is not considered monetary. The liability numbers are the same in both cases, and that is why the current rate gives us a better ratio. What about the total debt over total assets? The debt numbers are the same, but our assets will be higher using the current rate because all assets are being translated. You can also now work through the rest of the numbers. You need to recognize whether the foreign currency is going up or going down in your exam question, and then decide which method will give a better ratio. A point to emphasize here is that the net income with the temporal method is low, but the operating profit with the temporal method is high because the translation loss is not included in the operating profit. In any case, go through these ratios and make sure you understand where they are coming from. And here are some more ratios. Next, we come to section 3.5, translation when a foreign subsidiary operates in a hyperinflationary environment. The curriculum uses hyperinflationary and highly inflationary interchangeably. The learning objective uses the term hyperinflationary. So you need to know what US GAAP says in this scenario and what IFRS says. US GAAP is straightforward. US GAAP simply require use of the temporal method. On the other hand, IFRS require financial statements to be first restated for inflation, and then inflation adjusted financial statements need to be translated at the current exchange rate. Specifically, here is the process under IFRS. Monetary assets and liabilities are not restated. Obviously, these are already at fair value, so they can simply be translated at the current exchange rate. The non-monetary assets and liabilities need to be adjusted for inflation. They need to be restated, and restated costs are determined by applying the change in general price index to the historical costs. At times, the assets and liabilities might have been revalued. If items are carried at revalued amounts, then these are restated from the date of revaluation. All components of shareholders' equity are restated by applying the change in general price index from the beginning of the period or from the date of contribution to the balance sheet. All income statement items are restated by applying the change in the general price index from the dates when the items were originally recorded. Now, this procedure is carried out in example 4 that I mentioned earlier, and specifically in the third approach or the third alternative used in example 4. If you recall, with example 4, we talked about the current rate method, the temporal method, and then the third approach essentially was using this strategy. Also, I want you to go through example 7, and we will make a separate video available that describes at least the IFRS treatment in example 7 in detail. One other important point to note: purchasing power gains and losses that arise from holding monetary assets and monetary liabilities need to be included in net income. And remember, this is the net income of the parent company. When we translate the numbers from the subsidiaries' financial statements to the parent's consolidated financial reports, then there will be an item in the income statement called purchasing power gain or purchasing power loss. And just to understand the context, let's say that our subsidiary has a lot of net monetary assets. Simplistically, let's say that this is just cash. Clearly, if there is high inflation here in the subsidiary country, then we being the parent are losing purchasing power. So there is a purchasing power loss, and that needs to be reflected in the income statement of the parent. On the other hand, if there is a net monetary liability, then there will be a purchasing power gain, which will be reflected in the parent's income statement. Section 3.6, companies use both translation methods at the same time. And I want you to read this. This is an excerpt from the curriculum, but the core point is this: you can have a parent company with multiple subsidiaries. With one subsidiary, the temporal method makes sense. With the other subsidiary, the current rate method makes sense. And it is perfectly acceptable. And in fact, companies do use both methods. So that means that you will see translation gains and losses in the income statement, as well as translation adjustments in the equity part of the balance sheet. Section 3.7, disclosures related to translation methods. Both IFRS and US GAAP require two types of disclosures related to foreign currency translation: the amount of exchange differences recorded in net income, and number two, the amount of cumulative translation adjustment classified in a separate component of equity, along with a reconciliation of the amount of cumulative translation adjustment at the beginning and end of the period. We've talked about this, and this is fairly self-explanatory. There are a few other smaller minor items related to US GAAP which you can see in the curriculum, but at the very least I want you to remember these points. Then if you have time, go over examples 8 and 9. Section 4, multinational operations and a company's effective tax rate. This section and section 5 have been introduced for the first time in 2014. The point here is straightforward. When you have a parent company with operations in different countries, so let's say parent company and it has an operation in country X, country Y, the parent company operates in a country, let's say, with a relatively high tax rate, and it has operations in country X, country Y. Say the tax rate is relatively low in these other countries. Clearly, having multinational operations in countries that have different tax rates will impact the effective tax rate of the parent. And as a quick refresher from level 1, when we say effective tax rate, we are referring to the income tax expense divided by the pre-tax income. This part of the curriculum emphasizes this concept of transfer prices. And what is stated is that transfer prices refers to the pricing that a company establishes between its subsidiaries. So if the parent company is buying and selling from this subsidiary, the prices are referred to as transfer prices. Obviously, companies will try to establish transfer prices that minimize taxes. So if possible, the pricing will be set such that the tax exposure or the tax liability is in countries with lower tax rates. By doing so, a company can reduce its overall tax expense. However, countries obviously do not like this sort of strategy. So many countries establish laws and practices to prevent aggressive transfer pricing strategies. By aggressive in this context, we mean pricing strategies that try to minimize taxes. Also, whether and when a company pays income taxes in its home country depends on the specific tax regime. You might have a particular country where the tax rate is 40%. Companies based here might operate in other countries where the tax rate is 20%. So the tax regime of the home country might say that you pay 20% here in the foreign country, and then the balance is paid in the home country. This is one scenario. Later in corporate finance, we will talk about multiple tax regimes. At this point, you don't need to understand the specific tax regimes. Just recognize that different countries will have different tax regimes. From a testability perspective, you need to recognize that information about the impact of multinational operations on the effective tax can be obtained by studying the disclosures. And example 10 helps us do just that. We are given excerpts from the financial statements of two companies, Heineken, which is a Dutch company, and Colgate-Palmolive, which is a United States-based company. And for each company, we are asked about the statutory tax rate. This is the legal tax rate in the home country. We are asked about the impact of multinational operations. And then we are asked about changes in the tax rate and the impact of multinational operations. So let us look at these three questions for Heineken. Here are the financial statements. The first one has to do with the statutory tax rate. That is simply the domestic tax rate, which is 25%. What is the impact of multinational operations on the effective tax rate? We get that from this row. Note that the effect of tax rate in foreign jurisdictions was positive 1.9% in 2010 and then positive 3.5% in 2011. Positive in this case is bad because what this is saying is that the effective tax rate is going up. The company is now paying higher taxes. What does this suggest about the geographic mix of the 2011 profit? What this implies is that in 2011, the company expanded in countries where the tax rate is higher. So not explicitly stated here, but clearly the tax in the home country is relatively low. Possibly in 2011, Heineken expanded in the United States, which has a substantially higher tax rate. And so Heineken ended up paying a higher level of taxes. Here we have the numbers for Colgate-Palmolive. The statutory tax rate is 35%. And this column shows the impact of earnings taxed at other than the US tax rate. Notice that over the years, the impact has been negative. In other words, by operating in other countries, this particular company managed to reduce its effective tax rate. Section 5, additional disclosures on the effects of foreign currency. For multinational companies, sales growth is driven by changes in volume, prices, and exchange rates. As an analyst, you need to be able to figure out why the sales is increasing. So if we have a simple scenario where sales are increasing from 100 to 150, what we are saying here is that there are three possible reasons for this 50% increase. The first reason might be the increase in volume, so more goods are being sold. Another might have to do with increases in prices. And then in the context of multinational operations, a third reason might have to do with the change in exchange rates. If there is a favorable movement in exchange rates, then obviously that will increase the value of sales coming from multinational operations. Note that the sales numbers being reported are in the parent's presentation currency. You need to be able to decouple these effects or isolate each effect and recognize the fact that management has control, or relatively speaking, management has control over volume and prices. So increases in volume and prices are more sustainable relative to changes in the foreign exchange rate. So in a given year, if there is a favorable impact due to a better or higher FX rate, the increase in sales because of a higher foreign exchange rate is not sustainable. Management has no control over FX rates. You can go over example 11, which deals with some disclosures made by Procter & Gamble, a US-based company, and they define this metric called organic sales growth. Organic sales growth is not a term that you will see in IFRS or US GAAP, but effectively what Procter & Gamble is trying to do here is show the impact of variables such as volume and price and pulling out or removing the impact of changes in foreign currency rates. That is the main point. Again, if you have time, you can look at this. As an analyst, when you simply see a growth rate of say 20%, then you need to go through the disclosures and figure out how much of this might be explained by FX rates. As an extreme scenario, it might turn out that all this 20% increase is coming purely because of a higher foreign exchange rate, which means that the company cannot really claim any credit for this 20% increase. Also, in the disclosures, you will see that companies talk about exchange risk. And a good example is given related to BMW. BMW is based in Germany, so the presentation currency is the euro. BMW exports to various parts of the world, but the three major export markets for BMW are China, the United States, and the United Kingdom. So clearly the sales numbers reported by BMW will depend on these three exchange rates. What BMW does in its annual report or in its financial disclosures is provide a sensitivity analysis for each of these exchange rates. For example, if the dollar to euro exchange rate increases, then what is the impact on sales? Similarly, what is the impact on sales if this exchange rate changes? Or what is the impact on sales if the pound to euro exchange rate changes? That's called a sensitivity analysis and gives a sense for the riskiness associated with sales numbers, and specifically the riskiness that comes because of fluctuations in exchange rates. Now I will give you a quick summary of what we have covered in this reading. Very broadly speaking, I'd say that this reading has three parts. The first part deals with foreign currency transactions. Then the second, which is the major chunk, deals with translation. And then we have this final little chunk that deals with the impact of multinational operations on the tax rate and the impact of exchange rates on sales numbers. In terms of foreign currency transaction exposure, here we are saying that a given company buys and sells in a foreign currency. What then is the FX risk? And this is the simple table that you need to learn. Then we talk about translation. Here, a parent company has operations in other parts of the world and needs to translate the financial statement elements of the subsidiary into its own consolidated financial statements. The first critical point here is to understand that we have two methods, two translation methods. One is called the current rate method, the other is called the temporal method. If the foreign subsidiary's functional currency is not the same as the parent's presentation currency, then the current rate method needs to be used. Otherwise, the temporal method is used. You need to understand the impact on the financial statement elements of using these two methods. With the current rate method, all assets and liabilities are brought over at the current rate being the balance sheet date when the translation is happening. The revenue and expense numbers are brought over at the average rates for the year. Equity is brought over at historical rates. But then with the current rate method, the translation adjustment is shown in equity. It is not shown in the income statement. With the temporal method, monetary assets and liabilities are translated at the current rate. Non-monetary assets and liabilities are translated at the historical rate. The translation gain or loss is shown in the income statement. You need to understand the impact on ratios of using one method versus the other. And remember that the impact on ratios obviously depends on the method, and it also depends on the balance sheet exposure and the direction in which the currency moves. You need to understand the translation methods for hyperinflationary economies. Under US GAAP, we simply use the temporal method. Under IFRS, we need to restate for inflation and then use the current rate method. And then finally, part 3, when a company has multinational operations, then the tax rates of the subsidiaries obviously impacts the overall effective tax rate of the parent company. And also when a company has operations in different parts of the world, then the ultimate sales number which is reported is impacted by exchange rates. However, the impact of exchange rates is not sustainable. If we go with the simple assumption that exchange rates are mean reverting, then clearly just because exchange rate has a positive impact in 1 year doesn't necessarily mean that exchange rate will have a positive impact in the next year. That is it for this reading.